All right, welcome back, everybody. Everybody get the chance to download the homework solution from last night? Any questions on that? I've put it up on the screen. Anybody have any trouble finding the right data, getting it into the right places in Excel? And we're going to start talking a little bit about valuation today. Okay, and if you haven't gotten a copy of the valuation slides, they're on the back table. And then, of course, you've got the PDF of my slides in folder 2. Yep, so you can grab those. All right, what are we talking about? Why would we value companies? We want to understand what the value of that company might be in connection with the transaction. Anytime we have a transaction in banking or private equity, there's always the question, well, what is the valuation? All right, and so frequently as bankers, as private equity analysts, we're performing valuation analyses to figure out what is this company worth. All right, and in the case of pretty much any company, it can be worth different amounts to different types of buyers. All right, so the first thing we want to talk about is how valuation can differ among different types of buyers who might have different interest stakes in the company. Okay, so if we consider a private and independent food processing company, Company A, and we're going to keep using this hypothetical Company A over and over as our example in class. We're going to be valuing it. We're going to be building a financial model for it. We're going to analyze it as part of a leveraged buyout. All right, so I'm going to keep coming back to this private Company A. It's a hypothetical company. All right, but if we think of it in the context of valuation, specifically if we think of it in terms of how different buyers might value it, we can have very different values based on that buyer type. All right, so the first thing we're going to do is give an example of this. We have 3 different types of buyers in this case, 3 different groups who want to buy some equity in Company A. The first group would be an individual, maybe one of us, maybe a mutual fund, basically looking to buy some stock of Company A and be a minority shareholder. That is, maybe they'll buy 1 share. They'll get to vote their share every year, but they own far, far less than 50%. They certainly can't control the strategic or the strategy or the operations of the company. All right, so that's scenario 1. Scenario number 2 is now we've got a competitor, or what we would call a strategic buyer, looking to acquire not just 1 share, but 100% of Company A, merge it into its own operations, and through that, hopefully derive some type of cost or revenue synergies. Maybe they can shut down some duplicate plants, maybe they can lay off some, they can cut headcount, etc. But whatever they choose to do, they will attain some synergies as a result of that. All right, and then finally, scenario number 3, we've got a private equity firm, also referred to in many cases as a financial buyer, also looking to buy 100% of the company, keep it as part of its investment portfolio, obviously have strong influence and control over the company. All right. Which of these 3 buyers do you think would be willing to pay the most for Company A? 2. Buyer number 2, the strategic buyer. Why would that be? First of all, what happens typically when a buyer comes in and wants to buy 100% of some company? What do they need to do? What do they need to offer them over and above? Premium? They usually have to offer them something that's known as a control premium. All right, so if Company A's stock is trading at $10 a share, somebody comes in and says, okay, I want to buy 100% of the company for $10 a share. There's really not much incentive for the selling shareholders to take that price. All right, they already own stock at that's valued at $10 a share, and presumably they think it's going to go higher. Otherwise, why would they own it? All right, so typically what needs to get offered is a control premium, and that control premium gets factored into the deal price. So anytime a private equity buyer comes in and buys 100%, they're offering a control premium. Anytime a strategic buyer buys 100%, they're offering a control premium. But in the case of the strategic buyer, there's some additional value that they can achieve that a financial buyer might not be able to achieve. And those are those synergies we're talking about. All right. Because this is a competitor, they've got their own management team, they've probably got their own manufacturing facilities or maybe their own stores or their own operations or locations. They can cut headcount, they can eliminate duplicate expenses, they can fire the second CEO, cut out a big portion of their salary. All right, so that synergy value over and above the control premium is why a strategic buyer would be willing to pay a little more than just a financial buyer.
What's the meaning of synergy?
Synergy is basically saying 2 plus 2 equals something more than 4. All right, you combine these two companies, they do better together than they would have otherwise done on their own. We lower their expenses, their overall expenses. Maybe we can boost their revenues by selling the same or two different sets of products through two different distribution channels, that type of thing. Okay, so those synergies, however they get attained, have some value, and for that reason, the strategic buyer is willing to pay a little bit more. All right, so then obviously the financial buyer would be willing to pay the second most. All right, it's still control. They're still buying a controlling interest position. They still have to offer somewhere over and above $10 a share. And then finally, that minority interest buyer, they're basically a price taker in the market. They go into E-Trade, they log in, they buy a share at 10 bucks. Does that make sense? All right, so really what we want to do is just illustrate the concept that the same company can have different values to different buyers, different buyer types. And we'll talk more about minority interest values and controlling interest values once we get a little further into valuation. All right. Now, if Company A, let's assume Company A is a publicly traded stock. If they're listed on a stock exchange, then we can obviously value the company pretty easily. We can value it on a minority interest or a public market basis. We look up its stock price. We multiply by all the shares outstanding. Okay, we add in a couple other items of its capitalization that we'll talk about later, but that basically gives us a public market valuation, the same as that scenario one, all right, where a minority interest buyer would be buying just one share. All right, but typically in banking, we go well beyond just putting together a public market valuation. Typically, we're trying to value the company using a couple different valuation methodologies. All right, we're going to go through two of these today. But the three valuation methodologies are comparable public companies, right, precedent transactions, and discounted cash flows. Right. If you've ever taken a finance class, you've probably done a DCF model, at least a basic DCF model. But most folks who haven't worked in the industry probably have not spent a lot of time doing comps analyses or precedent transactions, also known as deal comps. All right, so we're going to talk about those first two today. We're going to do some examples of those. You're going to get to do some homework on those. And then next Saturday, actually 2 Saturdays from now, after Thanksgiving, we'll talk about discounted cash flows, weighted average cost of capital, all right, and building those types of models. Okay. Now, if we have some basic information on a company, as well as, of course, public market information, if we've got income statement data on a company, that is their revenues, their EBIT, their EBITDA, their net income, we've got their balance sheet. Okay, if we've got some forecasts, we can basically put together valuations of our company A using these different methodologies. All right, so we're going to go through that in a lot more detail. Any questions at this point? Now, like we said before, every transaction is going to require that we have at least some understanding of the fair market value of those assets or that company that's going to be part of that transaction. All right, and a fair market, when we say fair market value, that is one standard of value defined as basically the price at which non-desperate buyers, non-desperate sellers are willing to get together and do a deal. All right, the seller isn't in a forced liquidation situation, the buyer isn't in a must-buy situation. Okay, they've all got they've got all the knowledge of relevant facts. And we talked about this a little earlier when we talked about the homework. This market value, this notion of market value differs from a company's book value pretty much in all situations, except when the company first issues shares, they'll be identical. Beyond that, typically there'll be some difference between market value and book value. All right, so as a company's stock price is rising or falling in the markets, we're not making adjustments to the company's balance sheet to write up or write down its equity. Right, it's only at the point when the company does get acquired at some point that difference between fair market value and book value gets addressed. Remember we talked about goodwill yesterday, the notion of goodwill. That is an item that would get created by virtue of some type of transaction. That would be the difference between market value and book value. Okay, we'll talk more about that as well. All right, but when we say market value of equity, we're also referring to something, a term that you've probably heard called market capitalization, market cap. Has anybody heard that term? Basically, what is the aggregate value of a company's equity on a market value basis? All right, so we multiply its share price times its total number of shares outstanding, typically on a fully diluted basis, and that gives us the market capitalization of the company. All right. And as we know, that differs from book value or stockholders' equity on the balance sheet, as we just talked about. That's one important distinction. The other important distinction to make is that market value of equity does not equal the aggregate value of the firm. All right. The aggregate value of the firm is represented by something that we call total enterprise value. I'm going to give you the formula for that in a moment, but that takes into account all forms of capital that have been put into a company, whereas market value of equity just specific to the equity of the company. All right, remember yesterday we talked about debt versus equity, and some folks can invest debt into a company, some folks can put their money in as equity. Total enterprise value is going to capture the value of all capital that's been provided by debt holders, by equity holders, if there's any preferred stock on the balance sheet, preferred stock, that type of thing. Who's been exposed to the concept of enterprise or firm value before? All right. That's typically what we're looking to calculate in investment banking. We're typically looking for the total enterprise value of a firm, and our valuation exercises are really going to be geared toward figuring that out, then using that to derive valuation multiples. We'll talk about that a lot more later. Right, and when we talk about the total enterprise value of the company, we're talking about the value of its operations. Remember yesterday I put up the income statement on the board. And it wasn't just a remedial exercise. Remember I drew that line beneath EBIT and said everything above that is pertaining solely to its operations. Everything above that, because it relates to its operations, relates to the concept of enterprise value. All right. We touched on this yesterday, but finance theory tells us that if we're going to look at a company, we need to be blind. If we're going to value a company, we need to be blind in terms of how that company has been financed. It doesn't matter if they use 50% debt, 50% equity, 20% debt, 80% equity. At the aggregate or the total enterprise value level, that value remains unchanged. Let me give you an example. If we think of a house, I think this is a good example because most people are familiar with how houses get bought and sold and financed. If we think of a house, let's assume we've got a house that recently was bought for $500,000. Okay, how do we typically go about buying a house? How do we go about financing that purchase price? What do we do?
Mortgage company.
Yeah, we go to a mortgage company, we borrow typically as much as we can. All right. In recent years, that's been like 99% of the value of the home. But let's assume it's a more traditional mortgage structure where we borrow 80% in the form of a mortgage, also known as debt, right? And what else do? We put down the balance, $100,000 in this case, as equity. All right, so we've got 80% debt, 20% equity. All right, let's assume we have a housewarming party, we have our friends over, somebody asks, well, what'd you pay for this house? Would you ever say I paid $100,000 for this house? No, not at all. You paid $500,000 for the house. The house's value is $500,000. It doesn't matter how we financed it. The value is unchanged.
It's only worth $250.
Yeah, well, let's put the normal market, these recent market conditions aside. All right, but that aggregate, that total enterprise value is not dependent upon how we finance the house. It's really looking at that aggregate value. All right, so if you think of total enterprise value in those terms, if you think back to the example of the house, hopefully that'll make sense in distinguishing total enterprise value from a very common mistake that people make in equating market value of equity with total value. Does that make sense?
Is it as simple as saying debt plus equity is your total?
In this case, yes. All right. In the case of a company, there are a couple different ways companies can be financed. There's obviously equity. There's obviously debt. All right. We talked a little bit about the notion of preferred stock yesterday. Okay, it's another form of equity, but it is capital that's been contributed to the company to finance it. All right. So if the company has preferred stock, we would want to include that as well. All right. If the company has something called minority interest on its balance sheet, which we're going to talk about in a minute, we're going to define that. All right, but if they have that, we'll want to include that in the calculation of total enterprise value, and then we'll usually deduct cash. All right, so this is the formula for total enterprise value. All right, if you go on banking interviews, chances are you're going to be asked that. you know, what is total enterprise value? Conceptually, what is it? How do you calculate it? What's the formula? All right, so really important concept in the class. Does this make sense?
So we need to be blind to the fact as to whether they use common or preferred stock or.
Yes, and we also need to be blind as to the relative proportions of each in the capital structure. All right, this house value isn't going to change whether I put down 100,000 and borrow 4. If I put down 200 and borrow 3, this still stays the same. All right, at the end of the day, we want to capture the value of all capital that's been provided by all stakeholders to the company.
In that example that you're making, you put in a real asset, but what about if the total enterprise value is over like a hedge fund or something like that, and all of the assets that they have is like, let's say, derivatives,
Okay.
which is really paper backed by paper technically.
Well, in that case,
Is that affected?
when valuing a fund, typically people are calculating something called net asset value. All right, it's a little different in the context of valuing a fund or a real estate limited partnership or some other type of vehicle. What we're looking to value here really is an ongoing and operating entity like a company. A C Corp, an S Corp, an LLC that's got operations, not really a fund at this point. Does that help? Okay. All right, so if we've got this formula for total enterprise value, and we've got a company that has a share price of $50 a share, 200 million shares outstanding, no preferred stock, $2 billion of debt, no minority interest, and cash of 500 million, what would our total enterprise value be? Let's break it down. All right, market value of equity is calculated by multiplying share price times shares outstanding. All right, so 50 bucks times 200 million shares, 10 billion would be our market value of equity. Our debt is 2 billion, so we would add that in. No preferred, no minority interest, less cash of $500 million would give us enterprise value of 11.5. All right? So this is the formula you're going to see over and over. Our valuation template is going to use this. We're going to be using this as the basis of calculating valuation multiples. This is pretty important stuff. All right, so let's talk about minority interest. Okay, from an accounting standpoint, minority interest or accounting rules say that if we own more than 50% of something, let's say our company owns a joint venture, say Microsoft owns a joint venture with some third party, and Microsoft owns, let's say, 70% of that joint venture. Well, accounting rules tell us that if we own more than 50% of something, we need to quote unquote consolidate the books. So even though we own less than 100%, we are still accounting for that entity from a financial standpoint as though we do have 100%. From a revenue standpoint, we have 100% of their revenues on the books, cost of goods sold, gross profit, EBIT, EBITDA, etc. It's not until we get down right before the net income line that we take a charge for minority interest expense to recognize that someone else owns part of that company. All right, so from an accounting standpoint, we've got 100% of all their revenues, 100% of all their operating items. Right? Remember, everything down to EBIT relates to operations. All right, so what we need to do is when we're calculating valuation multiples, if our revenue, if our denominator includes 100% of that entity's revenues, our numerator has to include 100% of that entity as though we owned all of it. All right? Think of minority interest kind of like a liability. In order to do that joint venture, Microsoft put in its 70%. It had to go out and get capital from a third party. All right? It had to get financing for that other 30%. So it is that 30% is the proportion of the company Microsoft does not own. Think of minority interest as a liability. And if you look at it in terms of it being a liability, it can kind of take on the feeling of being debt, which obviously should be part of our total enterprise value calculation. And again, when we talk about something that includes net income, and in a PE multiple, the E stands for net income. Net income comes after that minority interest charge. So our stock price, we don't need to adjust because it already excludes it. All right. PE multiple is what we would consider a levered multiple. We're going to get to that in a moment. The multiples that have total enterprise value in their numerator would be those unlevered multiples. Touched on that a little yesterday. We're going to spend some more time on that in a moment. But at this point, does everybody understand minority interest? Make sense? Okay, then what about cash? Why would we subtract cash from the calculation? And the common misconception is that you would net debt against, or you would net a company's cash against its debt. That's how actually I was taught. It's not technically correct. Really, the reason why we take out cash is because excess cash that's sitting on the books of a company really doesn't contribute to the value of its operations. All right. If it is truly, we're assuming in this case, when we say cash, we're talking truly excess cash. All right. So if there's excess cash, it doesn't really contribute to the value of the operations. It would kind of be like buying a house, all right, with a $500,000 house that happens to have $50,000 of cash sitting in the living room. All right. It doesn't really change the aggregate value of the house. The house is still worth $500,000. Okay, we'd probably pay $550,000 and then turn around and take that cash and give it back to the seller. Same idea when buying a company that has excess cash. All right. The underlying total enterprise value does not change. This one's a little less clear to understand in some cases. There's also the example that we have of two runners of equal ability. Not my favorite example, but if it helps you understand it, then that works. All right, one runner has $5, the other has 100. The question is, does it necessarily make either runner a better runner, the fact that they've got differing amounts of cash in their pockets? All right, so let's start talking about the valuation methodologies themselves. All right, and the first one that we're going to take a look at is the comparable public companies analysis. And the theory here is that if we have a company, let's say our privately held company A, it's a food processing company. All right, so I can't just go online to Yahoo Finance and look up a stock price of company A. It's not publicly traded. But the theory tells us that if we find similar companies, that is, their same line of business, okay, working in the same industry, hopefully they've got the same business model, retailers compared to retailers, wholesalers compared to wholesalers. All right, and ideally if they've got similar levels of profitability, ideally if they're of similar size, hopefully they're growing at the same rate, hopefully they're serving the same geographies. But if we can find companies similar to our private company that happen to be publicly traded,